Will there be a big stock market crash in 2022? Well, so far this year, we've experienced some serious headwinds, including red-hot inflation, with the official figure now at 8%. Interest rate hikes are coming very soon. Pandemic conflicts going on around the world, and now most recently, a war breaking out in Europe. To say 2022 has been a very challenging year for investors would be an understatement. So the big questions are, is this all leading to a full-on crash in the markets? How long will this downturn last? And is there anything we can do to prepare? Well, those are the topics of this video. And so we'll be looking at the current situation, where are we right now in terms of the declines. We'll then take a snapshot look at the past 50 years and we can see how this year compares. We can then get a gauge of how long this might last and how deep this thing can go. And then we'll finish up taking a look at Warren Buffett. As he's one of the greatest investors of all time, how is Warren allocating his money? And what can us mere mortals learn from this? As always, if you do enjoy anything in the video, then drop a like. Always appreciated. Okay, so the first step is taking a look at where we are at right now. And market sentiment is pretty bad at the minute, especially if you like to read the news headlines each day. But let's take a step back and take a look at the numbers. Ready? Let's do this. So taking a step back from all the news and media headlines and seeing where are we at in terms of the numbers. So we'll be looking at the SPX, which is the S&P 500, which represents the US stock market. And we look at the US stock market as it's still the world's largest economy and has the global reserve currency. So a crash in the US stocks will affect all the stock markets around the world. And we can see as of right now, it's down 11%, which is a stock market correction. However, if we look at it day by day, then we see in January it had dropped down almost 10%, which was one of the worst starts to the year in decades. February, the trend continues and it went down almost 12%. And then at its low, it's March. So the downtrend is still going on and was down 13%. Another gauge for the market would be the Wiltshire 5000, which makes up all the stocks, the large, the mid, the small, the micro in the US, and it says a very similar picture. In January, it had got down past 11%, February 12.87%, and then March it's down almost 14%. So after everything that's happened, it's still only a stock market correction. So when it comes to stock market declines, they are defined by categories. Whenever the market has dropped by over 10%, this is called a correction. And whenever it drops by over 20%, this is called a bear market. Now, there's no official percentage for a stock market crash, but it'll typically range starting from about 30%, like the COVID flash crash we saw in 2020. A 50% crash would be considerable, which was almost hit in the 2008 Great Financial Crisis, and then the biggest crash of the last century was in 1929 when the Dow crashed almost 90%. So where are we at right now? Well, with the SPX down 13% at its lows, we are in fact only in a stock market correction, and considering everything going on right now, it's actually not too bad, especially if you like to read the news headlines each day. And while we're on that, just remember this: the news and the media should be a place where we go to find out what's going on and get access to the truth. But in reality, it's just a business like any other. And their job is to get your eyeballs on their stories. And this is how they make money. So just remember and have this in the back of your mind when you're reading news headlines. Okay, so the big question is, where do we go from here? Well, let's take a quick snapshot look at the last few decades and we'll see what's happened to the stock market in the past. So here we have some data brought to us by Goldman Sachs and published on CNBC, and this is all the market corrections since World War II. There's been 26 corrections that have averaged a decline of 13.7% over 4 months and have taken 4 months to recover. So what are the key points from this? Well, the first thing is that stock market corrections are very, very common and happen on average every couple of years. So it's nothing out of the blue. And the average decline of each one is 13.7%. And if you remember, as of right now, we are down 13%. And on average, it takes 4 months to recover. Now, if it keeps going down, we then move into bear market territory. Again, same thing from Goldman Sachs, and this time it's the bear market since World War II. There's been 12 bear markets that have an average decline of 30% over 14 months and taken almost 2 years to recover. So you'll notice these are less common, but they still happen on average every 5 years or so. Now, the decline is deeper, on average about 30%, and 2 years to recover. So these are a bit more painful. So less likely that we'll be going into a bear market, but still they are quite common historically. And last thing to cover, as it should be quite useful, as a war has just broken out in Europe, Tom Lee of Fundstrat, he looked back and crunched the data of 5 different wars and what had happened to the stock market. So he looked at the Vietnam War, the Gulf War, Afghanistan, Iraq, and Crimean. And the line that he punched through was when the actual invasion happened. And this was the build-up before it. And very, very interestingly, the market had either bottomed or was very close to the bottom just before or at the actual invasion. And as the war progressed, the market was going on to set all-time highs. And so he marks it as if you did invest right at the time of the invasion. Of 4 of the 5 times over the next year, the market was back in the money. So some positive data and just worth keeping this in mind. So what's great for investors is that we get to see what Warren Buffett is doing every single quarter, as he has to release his latest stock market moves as a regulatory requirement. Now, going back 4 quarters, we can see it looks like he's been preparing for this for quite some time, as there's a lot more selling and reducing of positions than there is buying. This was Q1 2021, Q2, a lot more selling and reducing than buying. Same thing for Q3, selling and reducing. And this is the latest that he's done, and the trend pretty much continues. Now remember, this is the broad-based stock market, S&P 500, and as of right now, it's down 11.2%, and this is the stocks of Berkshire Hathaway, Warren Buffett's company, and amazingly, he is up over 7%. At a time when everybody else's portfolio is going down. And this is probably why he's one of the world's greatest investors. So let's take a look at how his portfolio looks right now. And here are the stocks of Berkshire Hathaway, and it's made up of 45 positions with a total value of almost $500 billion now. And you'll notice his portfolio is very, very simple. His largest position is Apple, the world's largest company, a very, very safe stock, and he also benefits from all the index fund investing going on. As everybody who invests in index funds, Apple will be the biggest beneficiary. Next point to note is that he has got a historically large cash position, 33%. And this is going to be great as protection, as if the stock market does crash, he's got a lot of money to deploy. Next point is that he has got some solid value-based stocks with Apple, Bank of America, American Express, Coca-Cola, and these stocks will tend to do well in good times, but also in bad, as investors tend to get out of riskier options. So some great lessons we can take from Warren Buffett's portfolio. Okay, so let's try to bring everything we've covered together. And the first point, unfortunately, nobody knows the future, so we can never talk in absolute terms, like the stock market is going to do this, and be wary of anybody who claims to know the future. There's always risk with investing, and we can only ever work with probabilities. And the facts are, right now, the stock market has only just entered into a correction, which is something that it's done every couple of years for decades. So it's nothing out of the ordinary. Remember to be careful when reading the news headlines each day, as these are just businesses like any other, and they make money by getting your eyeballs on their stories. The big 50% stock market crashes that we keep hearing about are in fact very rare, and only a few will happen every 100 years or so. So statistically, it's the least likely to happen. However, it's always good to have a plan just in case. The data on wars was in fact very surprising, and of the 5 wars looked at by Fundstrat, they found that the actual bottom of the market happened around the time of the invasion and not months into the conflict. And I'd say this is a very positive sign. And investing titan Warren Buffett is actually prospering in a time where the vast majority of people's portfolios are going down. How? Well, he's carefully selected some good value-based stocks, which tend to do well in good times and bad times. He's got a good selection of dividend-paying stocks, so he maintains a strong source of income, and he's maintaining a historically large cash position. So if there is a stock market crash, he can take full advantage, as he does have the patience to wait for the market to recover. So some great lessons we can all learn there. So there you are, guys. Hope you enjoyed. Tell me, what was your biggest takeaway from all of this? Let me know below. And for now, just to say, if you did enjoy anything in the video, then drop a like. And a big thank you to everyone who does. If you haven't yet subscribed, click below and join us. Got some great videos coming up that you don't want to miss. Okay, cheers guys. Thanks for watching, and I'll see you in the next video. Bye for now.